Buy, borrow, die. Buy, borrow, die. It is a phrase that sounds stark, even a little grim, yet it describes a powerful financial strategy used by some of the wealthiest individuals. It helps them manage and grow their fortunes, and it legally minimizes their tax obligations. This isn't about illegal tax evasion, it's about using the existing tax code in a very specific way. At its heart, the strategy is simple. It involves purchasing assets that appreciate in value. It involves taking out loans against those assets for cash to live on. And it involves holding those assets until death. That allows someone to access wealth without selling the underlying asset, avoiding the capital gains tax a sale would trigger. People are paying close attention to this because it gets to the heart of the debate about fairness in our tax system. When headlines show billionaires paying little or no federal income tax in some years, this strategy is often part of the explanation. It raises fundamental questions. Is this a savvy use of rules anyone could use, or a loophole that benefits only the ultra-rich? The entire strategy begins with a single foundational action: to buy. This isn't casual shopping. It involves strategic acquisition of assets expected to appreciate over the long term. Not for quick flipping, the goal is long-term appreciation. Examples include stocks in publicly traded companies, shares in private businesses, fine art, commercial buildings, luxury homes. These assets can grow significantly over decades. Someone might buy shares in a promising tech company or purchase a piece of land in an up-and-coming area. The initial purchase sets the stage for everything that follows. Once purchased, the second part is to hold. This requires patience and a long-term perspective. Resist selling, even when value has soared. Selling creates a taxable event. It crystallizes gains into real profit, and taxes are due. By holding, net worth rises as assets appreciate, but gains stay unrealized. Wealth sits on a balance sheet, not converted to cash that triggers income tax. Patient holding is the cornerstone of the strategy. This mindset differs from an active day trader or flipper. Those people profit by frequent buying and selling and pay taxes on short-term gains. Buy, borrow. Die practitioners are investors, not traders, playing a longer game. They focus on quality assets to serve as lifelong bedrock. This often involves significant research, professional advice, and belief in long-term economic or sector growth. The initial buy decision is one of the most critical moments. Scale separates the ultra-wealthy from the average investor. While anyone can buy a few shares, the strategy transforms when assets are substantial, acquiring millions of persons stop buying or even hundreds of millions or buying of dollars in assets. That scale creates collateral to secure the big loans in the next step. A large, diversified portfolio of stocks, a collection of valuable properties, a major stake in a successful company, provides the foundation that makes lenders comfortable extending large lines of credit. The bigger the asset base, the more powerful the strategy becomes. The second pillar of the strategy is to borrow. This is the ingenious step that unlocks the wealth that was built up in the buy phase. Instead of selling the appreciated assets to get cash, the owner goes to a financial institution, like a private bank or a brokerage firm, and takes out a loan using those assets as collateral. For example, if you own $10 million in stock, a lender might give you a multi-million-dollar line of credit. This loan provides immediate liquid cash that can be used for anything: funding a business, purchasing a yacht, covering expenses, even philanthropy. The key point is that this cash is received as loan proceeds, not as income. From a tax perspective, this is the magic moment. Because the cash is a loan, it is not subject to income tax. You did not sell the stock, so there is no capital gains tax to pay. You have effectively accessed millions without sending a check to the IRS. This contrasts with a typical high-income professional, like a doctor or lawyer, who earns a salary. Every dollar they earn is taxed as income. The borrower can live extravagantly on borrowed funds and report a relatively low, or even zero, taxable income. This is how some of the richest people can have a small tax bill. The final, and perhaps most controversial part of the strategy, is to die. Blunt, but accurate from a tax planning perspective. Under current United States tax law, when a person dies, assets often receive a step-up in basis. This is a crucial and incredibly valuable provision. The cost basis, the original purchase price, is adjusted, or stepped up, to fair market value on the date of death. This single rule can erase decades of capital gains. Let's, trace how this works. Imagine an investor bought a stock for $1 million many years ago. On the day she dies, it's worth $25 million. The unrealized gain is $24 million. Selling the day before death would trigger a massive tax bill. By holding until death, heirs inherit with a new basis of $25 million. The $24 million of lifetime appreciation is never taxed as capital gains. They could sell the next day and owe little to no tax. This also cleans up prior loans from the borrow phase. The estate can sell a small portion to pay outstanding debts with little or no taxable gain. The remaining fortune passes largely intact, free of embedded gains. A complete reset, enabling efficient generational transfer. To make this concrete, let's walk through a simplified example. Meet Charles. In 1996, Charles bought 100,000 shares. He paid $10 per share. His total investment, his cost basis, was $1 million. He holds the stock for the long term. For the next 3 decades, the company grows. By 2026, it trades at $500 per share. His $1 million is now worth $50 million. An unrealized gain of $49 million. If he sold, he'd face nearly $10 million in federal capital gains tax, plus state taxes. Instead of selling, Charles borrows. He needs $2 million for living expenses, and $2 million to help his children with down payments. His $50 million portfolio is excellent collateral. The bank extends a line, and he borrows $2 million. He pays a modest interest rate each year, a fraction of his ongoing gains. He gets the cash, keeps the portfolio, and avoids a massive tax event. He continues this way for years. Fast forward, Charles passes away. The stock portfolio is still worth $50 million. He still has a $2 million loan outstanding. His children inherit his estate. Because of step-up in basis, the basis becomes $50 million. His $49 million gain is forgiven for capital gains. They sell 2 million of shares at their new basis, realizing zero taxable gain and retire the loan. While the buy, borrow, die strategy sounds foolproof, it is actually fraught with real risks. The most immediate danger is the borrow component. Using assets as collateral introduces leverage, and leverage is double-edged. It can amplify returns, but it also amplifies risk. The biggest threat is a sudden steep market decline. If collateral values plunge, the lender can issue a margin call, forcing more collateral or immediate repayment, often triggering sales at the worst possible time. And those sales can trigger capital gains taxes. A severe crash can wipe out wealth and upend plans. Another big risk is a change in the law. The tax code changes with the political climate. Step up in basis is a frequent legislative target. If that happens, the die part loses its power. Heirs could inherit original basis and face taxes on decades of gains. Finally, there are real costs and complexity. Loan interest drags performance and demands steady cash flow. Managing leverage and multiple loans requires expensive pros, tax attorneys, accountants, and wealth managers. This is not set and forget. It demands vigilance and resources. In summary, buy, borrow, die is a sophisticated wealth strategy. It lets those with significant assets access liquidity by borrowing against appreciating investments, avoiding asset sales that trigger capital gains taxes, and at death, step up in basis can wipe out a lifetime of gains for heirs. It's a powerful way to preserve and grow wealth across generations, but it is not simple or risk-free. It relies on leverage, which can be dangerous in volatile markets. The core message: this strategy is not for everyone. It suits a very small fraction of people with large, stable portfolios and the discipline to manage debt over the long term. It requires high risk tolerance and the ability to withstand downturns. For most people whose wealth is a 401k or a family home, simpler, direct saving and investing is more appropriate. So, what should you take away? Do not try to replicate this strategy on your own. Seek professional financial advice tailored to your situation. Schedule a meeting with a certified financial planner or a tax advisor. Buy, Borrow, Die touches on universal concepts, benefits of long-term investing, the nature of capital gains taxes, and the importance of estate planning. Understanding these can help you ask smarter questions and decide better. If you've accumulated assets and want efficient management and transfer, the clear next step is to seek qualified counsel. They'll explain the rules that apply to you, assess your risk tolerance, and create a sensible plan, from simply selling and paying taxes to more complex trust and estate options. Finance is complex. You don't need to navigate it alone. Get advice, stay informed, and make the code work for your goals.